Okay, so let's get right into it. If you're following the tech scene in Latin America, you know Mercado Libre is an absolute giant. But, lately, its stock has been telling a very different story. Today, we're going to unpack what's really going on behind those numbers. And it's a fascinating story about this kind of hidden engine that powered just incredible growth, but also the risks that came along for the ride. And what happens when that engine starts to sputter?
So let's just start with the number that says it all. Almost a 20% drop in just 6 months. Now, for a company the size of Mercado Libre, that's not just a little dip. That's a full-blown alarm bell. It's telling you that investors are seriously rethinking the company's future. So what on earth could cause such a massive crisis of confidence for a market leader like this?
Now, your first thought, the easy answer, might be competition, right? Maybe Amazon is finally making a huge dent. But that's not really the heart of the problem here. The real source of this whole downturn is actually hiding in plain sight. It's coming from inside the company, from its own fintech powerhouse, Mercado Pago. The biggest threat wasn't some external rival. It was brewing right under their own roof.
So to really get why this is happening, we've got to pop the hood and look at the engine. Because for years, Mercado Pago wasn't just, a nice little feature. It was the absolute growth engine for the entire Mercado Libre ecosystem. So what is Mercado Pago exactly? Well, it's the company's fintech division, sure, but it's so much more than just a pay now button. Think of it as a massive financial services provider. It's offering credit, personal loans, and payment processing to millions and millions of people, not just on the Mercado Libre marketplace, but for tons of other businesses too. And this is where the strategy was just so brilliant. Mercado Pago created this amazing, self-reinforcing cycle. It would give credit to consumers. And what did a whole lot of those consumers do with that money? They turned right around and spent it on the Mercado Libre platform. So more credit meant more sales. It was this perfect flywheel that just supercharged their growth and made the whole ecosystem incredibly sticky. But here's the catch. That engine, that whole system, is only as strong as the consumer who's powering it. And right now, all across Latin America, that consumer is, they're breaking under some really serious economic pressure. Let's take a look at what that means. So let's break down what the average person is dealing with. First off, you've got crazy high inflation, which just means your paycheck doesn't stretch as far as it used to. At the exact same time, interest rates are going up, which makes all your debt, your credit card, your loans, more expensive every month. All of a sudden, the risk that people just can't pay their loans back, what's called delinquency risk, it starts to shoot up. And for Mercado Pago, it also gets more expensive for them to even get the money to make these loans in the first place. And this kicks off a really dangerous negative feedback loop. So, step 1. Defaults start to rise as people struggle to pay. Step 2. In response, Mercado Pago has to get way stricter with its lending to protect itself. That naturally leads to step 3. Slower loan growth, because fewer people can even qualify. And here it is, the knockout punch at step 4. That slowdown in credit spills directly into the e-commerce business. Less credit means less spending. That beautiful growth engine just got slammed into reverse.
Okay, so how do investors, and the company for that matter, actually measure the damage? Well, there are a few key numbers they watch like a hawk to see just how healthy or, unhealthy Mercado Pago's loan book really is. One of the biggest immediate hits comes from a really wonky accounting term called loan loss provisions. But here's what it means in the real world. As the risk of people not paying back their loans goes up, the company is legally forced to set aside more cash today to cover those losses that might happen tomorrow. And that money, it comes directly out of their current profits. So even if revenue looks great, the bottom line can get totally crushed. This is basically the dashboard that analysts are staring at all day. They're tracking things like non-performing loans, which is just a fancy way of saying loans that are seriously overdue. They're also watching the net interest margin to see if lending is even profitable anymore. Every single metric here tells a piece of the story about the health of their loan book, from which countries are struggling the most, all the way down to how loans made last year are doing compared to loans made today. So all of this leads to the billion-dollar question, right? Where does Mercado Libre go from here? Well, we can kind of map out 3 potential paths for the next, say, 6 to 9 months. Okay, so in the bull case, the absolute best-case scenario, inflation cools down, interest rates get cut, and the consumer can finally breathe again. Defaults fall, and that growth engine can fire back up. Then you have the bear case, the total opposite. Inflation stays high, defaults spike, and profits get squeezed hard. The most likely path, though, the base case, is probably somewhere in the middle. A tough period of slower growth and tight margins while the company just tries to navigate the storm. So what can the company actually do? I mean, they're not just going to stand there and take it. They can respond by getting way tougher about who they lend to. They can get better at collecting on overdue loans. They can even shift towards safer kinds of credit. And of course, they can try to make money in other ways, so they're not so dependent on these risky consumer loans.
At the end of the day, I think this quote from Investment Underground just nails it. The crisis Mercado Libre is facing right now, it isn't about Amazon. It's about the market waking up and realizing the real risk that was buried deep inside the company's own growth engine, its Fintech division. You know, what's happening at Mercado Libre really isn't just about one company. It forces us all to ask a much bigger and maybe a more uncomfortable question about the whole Fintech industry. When growth is fueled this aggressively by giving credit to consumers, just how stable is that foundation? Is this model of supercharged Fintech growth actually built on a house of cards? That's definitely something to think about.